Great philosopher Yogi Berra once said, you get to the fork in the road, you got to take it, right? So, we got a couple ways we can go tonight, folks. You can go out and buy your own property. Plenty of good reasons to do it. Many in the room have done it. First and foremost, you have to have sufficient capital to invest. You have to have the time and energy to manage it, or at least hire and supervise professional managers. You need to have a working knowledge of financing, leases, leasing agents, and property management. And you may be geographically limited. Alternatively, we offer Sabre Equity Partners. Small investment amount, $100,000 per share. Pay a regular cash dividend, monthly, distribution, monthly. Unleveraged. We're going to buy a property all cash, so that from a risk point of view, where we've reduced the risk to the lowest possible level from a financial theory point of view. It will be tax advantaged. The depreciation will be distributed to the shareholders. And it's an opportunity for those of you that may want to do more in the future. It's kind of like training wheels. You get to receive the value of our collective wisdom and experience, minimal time investment, and you can relax, you can learn, and you can earn. This is a bold new initiative. It's not been done many places. And our goal is to enable a segment of investor clients to enjoy the benefits of commercial real estate ownership while minimizing the obstacles and risks. The current economic climate has created the greatest commercial real estate opportunity in our lifetime. I mean, real estate's on sale. Don, if your wife goes to shopping mall and she sees a sign, sweaters, 50% off in some first-class store, is she probably making a turn in that store? Okay. You darn tootin' she is. My wife would be too. And real estate's on sale, folks. It really is. And if you don't believe it and you don't do this or something else like it, you're going to miss the boat. You really are. In 5 years now, you're going to be going, recession in 2009? What recession? There, of course, is barriers and pitfalls to be avoided. And that's where you need the knowledge and experience of professionals like us to help you. We will leverage the cumulative professional experience, skills, and knowledge within our organization. You saw before our resumes briefly. We've got a very broad background here. And we're not just salespeople. We've done this for our own money. That's important to understand. We've got skin in the game here. These offerings will be designed to provide smaller, passive investors the ability to pool together their funds and take advantage of commercial real estate opportunities. These offerings are also designed to be suitable for IRA and 401k type investments. We talked before, long-term financial goals, financial planning, financial future. Sabre Equity Partners can easily accommodate retirement type funds. Our initial approach is pretty simple. We're going to pull together investors, $100,000 share. We'll consider taking half shares. We'll buy high quality, well-tenanted office buildings or shopping centers. Multiple tenants equals risk diversification. We're looking for strong credits. We're going to target properties in the range of $3 million and higher. We'll consider smaller deals if they're particularly strong and attractive. We'll purchase properties with a cap rate in excess of 8%. There's no place out there. I think you're going to go now and buy a stock on the New York Stock Exchange or even the NASDAQ that's going to pay an 8% dividend or anything, even half that. We're going to acquire the properties all cash to minimize the risk. And then we're going to convert that cap rate, that 8%, into a monthly distribution tax advantaged. And then we'll be looking for the timely return of our investors' capital while retaining equity. We'll use Sabre brokers for the acquisition and property management and leasing. We'll provide a distinct possibility here. I kind of see two possibilities. If we get lucky and we hit a property in the area that the next 3 to 5 years just skyrockets, we'll probably circle the wagons with our investors and we'll probably sell the property. Create the opportunity to do a 1031 and do it again. More likely, we'll just get a good solid property that'll be well managed with good credits and we'll just crank along. And 5, 6, 7 years from now, that property is going to be worth a lot more than we paid for it. We go to the bank, we take a 50, 60% loan to value mortgage on the property. We can then pay our investors back every penny they've put into the deal, and yet they'll still own their portion of the property. You got the money back, you can do something else with it, and you own your hunk of a building.
Tax consequences if any of you do that?
If it's a cash out tax distribution, there are no tax consequences.
Okay, that's what I wanted to hear you say.
Yes, sir. If we sell it, there are. And if we were to sell it, we would be looking to create 2 escape routes, one a 1031 route and a non-1031 route, so that the investor could make that selection for themselves.
What's the legal setup? Because I would assume that if
Good question. If you can just bear with me for 1 sec. Great question. We're going there. Very simply, once you all have received 110% of your money back, we get 30% of the building. And it'll be a secure hedge against inflation, and we'll look to sell the property somewhere in the 5 to 15-year time frame. As far as structure, each property will be purchased in a single-purpose limited liability partnership. The property will be purchased, will be identified in advance. Everybody's going to have a chance to sign off on a particular property. We're not looking for any blind money, full disclosure, complete transparency on everything. We'll offer the property through a private placement memorandum. We will be dealing with properties small enough and with financial security regulations at a low enough level that will be exempt from all the Regulation D exemptions of the SEC. That just means a whole lot less hassle for all of us, and it means a whole lot less cost for the project, unlike, say, a REIT. We will form Sabre Equity Management as a Connecticut corporation. Sabre Equity Management will take a 1% position in the property, and they will serve as the managing partner. And we'll do business as much as possible with Sabre-affiliated entities to keep the costs down and maximize control. Now, we don't not just go out and pick up a property willy-nilly. We're going to do our due diligence. What's due diligence encompass? Well, for those of us that are real estate professionals, there's a lot of factors. I'm going to highlight just a few up here. Most importantly, you want to know about the location, and you know about the competition in the location. What's happening now and what's possible. First building I bought, I made a little bit of a mistake. I bought in a relatively undeveloped business area in New Bern, North Carolina. Nice building, everything's great. But you know what? Half a mile down the road, there's another mile of vacant land. And I've owned that building 11 years, and it has not appreciated as well as some of my other investments, because every time the rents start to bump up, there's just enough money for somebody to go out and go down the road another mile and build another building. So you need to know about the current and the potential for competitive spaces. You want to look at the current management. Are they doing a great job? Are they screwing up? If they're screwing up, there's probably some real upside. You want to look at the tenant mix. You want to look at the creditworthiness of the tenants, and then you want to look at the creditworthiness of the tenants, and then you want to look at the creditworthiness of the tenants. You want to look at the lease terms and the expiration cycles. Just had a nice building come across my desk yesterday down in Georgia. 9,000 square foot building. All the tenants come due within a 6-month period. 6 tenants. Now, are the odds that they're all going to go away? Probably not. But if you got 2 or 3 all at once, all of a sudden you got 50% vacancy rate. If you're leveraged, it could be tough. So the lease term and the staggering of the expiration cycles is a very important factor. Of course, the physical inspection, is there deferred maintenance, environmental, all those kinds of due diligence things. They're pretty straightforward in today's age. They've been pretty well documented, but they're important. They have to be done. And most importantly, a thorough financial analysis, and even more, a consistent financial analysis. You have to use standard assumptions that are reasonable for the market regarding things like management fees, things like bad debt loss, and most importantly, things like vacancy rate. Looking in Florida, we had banks that were willing to take a 3% vacancy factor. We had banks that wanted a 12% vacancy factor. Makes a big difference on the cap rate that they use and what they're willing to lend. So when we're looking for property, that's a very, very important factor. We have a standard financial model we use, and we use historical and current market data to benchmark those things. This is a little sample project. This property's already come and gone on the market, but it's a good example of the kind of property we'd be looking at. This is an office building in Shelton, Connecticut. Class A office space, 46,000 square feet, 90% leased. The asking price is $5.4 million. The net operating income was the stated net operating income. We didn't do due diligence on this. Is $481,340, which gives an asking cap rate of about 8.9%.